When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Fogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Fogan. And now here's Jeff Fogan and Jeff Shade.
Thank you so much. Welcome to Premier Retirement with Jeff Fogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. I'm Jeff Shade, and I'm just here to ask the questions, but of course the words of wisdom and solid advice, well, they come from Jeff Fogan, founder and president of Premier Retirement Planning and Wealth Management in Tucson and also up in Mesa. Hey, Jeff, how's this weekend finding you?
Well, it found me. I found it, and found you and the listeners, and we're all here. So
that's right.
So far, I think we all found each other very well.
Yeah, it's good to be here with you. It's good to be with our listeners. Jeff, so much to talk about on today's show, and one thing, you are never stuck with an answer for the questions that I have for you. So let's get on with it. Last Monday, certainly it was a little bit of a nail-biting time on Wall Street. Can you break that down a little bit? What happened on Monday? And, of course, we'll be talking about an emergency rate cut if that's going to happen. But what happened on Monday?
Well, I think it's just the aftermath of people had a weekend to stew over the crappy news we got. Actually, it wasn't crappy news. It was news we've already had, news I talk about all the time. And that is that the economy's not in as good a shape as we thought. Inflation's really still a problem, even though, 2.5% seems, it's a great deal. But keeping in mind that it's still on top of 25 to 30% inflation overall, since Biden took office and, continues to make life harder and harder for the real people, the average Joe. Rich keep getting richer. Inflation helps rich people because their portfolios go up with all the manipulation going on with the market. They can charge more for their business goods and services, typically, if they're business owners. Trading's got way out of whack. So, people in the financial business that are trading. So the rich people, the wealthy echelon of the world seems to be okay with this. They can still buy houses. They can still go out and pay cash for things. But the middle class, probably 80% of the public is struggling. So we're finally seeing it come out in employment. That was the big news that we got a week and a half ago or so. And that was that, we're in our fourth or I guess it's fifth month now of increasing unemployment. A year ago, it was about 3.3 and now it's 4.2. So it's gone up almost 1 full point percentage in a year. And that's bad news. That typically says, we are in a recession. Now that's based on numbers that we continually get revised. All the jobs created and unemployment, all these numbers keep coming out. Bureau of Labor Statistics, and then that Jared Bernstein guy in the White House that just is a BS, or if his lips move, he's lying. I know I'm a little opinionated, but that's a fact. I mean, that's just every time he says something, it just comes out revised later at a different number. Uses bogus data to come up with jobs numbers like the birth death matrix. What the heck is that? It means nothing as far as actual jobs. You got companies like ADP that do payroll that can tell you how much the jobs really are created. You also have the government fudging jobs by saying, anything that's a government job or a work permit is considered a job and somehow gets counted in GDP and all these other things that, they've been BS and making it look like, the economy isn't great, Bidenomics is working. But you ask anybody on the street that isn't wealthy, owns a business or, has a bunch of money in the stock market that's going through the roof, how life is, if it's easier or better than it was a few years ago, most people are going to say, no, it's tougher and the economy is tough. We've got IBM, we've got Intel laying off tons of people. We've got all these companies in with lower and lower earnings. We had a year with negative earnings in 2022, and 2023 earnings were flat, and they're getting all crazy because the S&P earnings look like they're growing at about 7 or 8% this year. Well, how in the world is the stock market going up 40%, 50% since the bottom of the correction that didn't turn into a crash because the Fed intervened and they printed money and gave money to the banks and pretended like they're doing quantitative tightening, but they weren't. And kind of backdoor fix the problem with the banks and the brokerage firms who continue to prop the stock market up and continue to sell and divest their positions, their inventory of stocks to the private sector, which is an indicator, again, of how bad the economy is. If the inventory holders and the market makers, the richest people on the planet, the broker dealers, are selling more stock than they're buying, yet they're still BSing to prop it up, they're the insiders. They're the ones dumping stocks. You've got Bezos, you've got Zuckerberg, you've got Tim Cook, Apple. We're talking about all the major CEOs. We've got Bezos over $1 billion in stock that he sold. You've even got NVIDIA CEO selling 100 plus million just in the last few weeks. These insiders, the people that own these companies, companies don't have to sell stock to take profits. Why would they if they think the stock still has upside and pay taxes on it? Heaven forbid. They've got to pay at least 20% taxes plus surcharges on all that money when they could just borrow it from a bank, and use the stock as collateral and never pay tax at all. That's how rich people get away tax-free, is because they've got huge holdings that they can borrow from and live tax-free. So, if they're willing to pay taxes and get out, there's all kinds of indicators that, this economy really isn't doing that well. So this is all going back to that original question. What happened last week, especially Monday when we had the biggest drawdown in a long time? Well, the prior week, we found out that unemployment ticked up 1% from last year, and we've had 5 months, I believe it's 5 months now, of unemployment ticking higher and higher. Every recession that finally comes out on a graph in the future finally says, oh, when did the recession start? And the recessions always start, about the time we've had 4 months of unemployment increases. And we've had that. We had, like I said, IBM and Intel, I think, were two companies that said tens of thousands of people to be laid off. And that's after, all the other big Magnificent Seven companies that said we're having layoffs and, dumping people. Even companies that aren't so big and well-known have had massive layoffs and restructuring in order to combat the inflation problem, to try to create earnings for their stock, and to make the stocks look good in spite of the fact that everything would indicate that the economy is bad and the economics are such that they have to do these big employment dumps and layoffs and hiring. Hiring right now is the lowest it's been in a decade. Right now, that doesn't sound like we're not in a recession. I'm sorry. We also have what I've been talking about for 2 years, and that is, hey, the yield curve inverted. That means sometime within the next 11 months to 2 years, we're going to have a recession and the market's going to correct. Guess what? We're like in the last month of that 24-month period where the market's due to correct. And that's 100% historical fact as far as history repeating itself. We always say it's going to be different this time, but guess what? So far, it hasn't been. And, it wouldn't really surprise me, and I've mentioned this in recent programs, that if for some reason this recession takes more than 24 months to materialize, that doesn't mean the statistics are wrong. It just means in the last 65, 70 years, they've all happened within 24 months of the yield curve inverting. The yield curve meaning long-term interest rates are lower than short-term interest rates. Well, those short-term interest rates were propped up in order to fight inflation. But unlike other programs, when we've done quantitative tightening or just increasing interest rates, is quantitative tightening is where you actually take money back out, actually reduce the money flow, the monetary supply, the money supply that's available to spend in the public, right? Or even businesses. So it's quantitative tightening, meaning we're taking money out. I don't think we've hit $1 trillion in quantitative tightening, even though our debt's up to like 34 trillion dollars. And we've increased that by like 20 trillion in the last decade or so. So we put 20 trillion into the system, quantitative easing, driving interest down to zero, creating all this extra economy. So there's all this extra cash flow. But during most of the last decade or so, we've had companies use that low interest rate to their benefit, create more economic growth, create earnings. Now, of course, it helps the rich get richer, but it also keeps interest rates down and keeps prices down because there's competition. Manufacturing is in good shape, during this period of time. Not right now, but it was. So that companies actually had earnings growth. 10 to 20% was common. Some was even 50 or 100% earnings growth during these robust times when the quantitative easing actually lowered interest rates and actually became part of the economy and generated GDP. Now, it's kind of a fake way to do it, but it does stimulate the economy, and it did so. But then what? You've got this full bucket of all this printed money. You've got all this extra production. You've got all this extra growth, all this extra wealth. And then anytime there's a supply chain hiccup like there was during COVID, all of a sudden now it's like, okay, inflation comes and rears its ugly head and basically shuts down the world of the normal person that has to make ends meet and buy stuff and pay rent and buy homes and buy cars and things like that typically like to borrow because prices are so high that you have to borrow, because during this economic period of printing money, prices have gone up. But because interest rates have been so low during the same period of time, you get people that are able to afford things, and it doesn't look like things are really a problem until we get back to a normal interest rate. Like 5% isn't abnormal. It's not really even high if you look at history. It's actually pretty tame. To go out and pay 6 or 7% on a mortgage doesn't seem all that bad if you look at the first 4 or 5 mortgages I had. So all of a sudden we're in this like utopian fantasy world for 10 or 15 years where the government prints money. And all of a sudden now we're in this inflationary time. They say, oh, we got to take the money back out of the economy. They've only taken like $1 trillion out. At the same time, they've propped up banks to the tune of probably 2, 3, 4 trillion probably. I don't know the exact numbers, but I know that, for example, the Fed funds rate that they allow banks to use to balance accounts during the night is called the repo fund. Used to have about $2 trillion in it. Last I heard, it has like 600 or 800 billion, which means, there's about $1 billion of that that's still sitting in banks that they're using for their own purposes rather than clearing deposits and checks overnight like they're supposed to. You've also got the bank did a bank term funding program that was supposed to help the banks out a year and a half ago when they were all going out of business with Silicon Valley Bank's failure. And they had to prop up the banks because, of course, the banks can't do business responsibly, spend less than they make, loan money at competitive interest rates, collect money that they loan out, and keep their deposits, where they ought to be. All of a sudden, every time they get in trouble, they look for a handout from the Fed. And they go, hey, Fed, bail us out, please. We got all these loans. And, you shut down the economy during COVID, so we're hurting. And that was probably a reasonably good argument. But banks should still be in good enough position to hedge their own bets, to do their credit swaps and options and plays that will, support them in bad times. But instead, they went to the government and said, hey, we got all these bad loans. Can you, at least, not let these defaults kill us? And so the Fed basically swapped them a whole bunch of trillions of dollars to the banks, the big banks mainly, all of which said, oh, good, we got this money to use. Now we don't have to worry about some of these bad crappy loans not paying. We can just play the market. So they started buying their own stock. They started buying NVIDIA, buying the Magnificent Seven or the Fab Five or however many there was left, a year or so ago, and driving the markets up. All the while, the inventories of those same banks are going lower and lower. Well, why is that? It's because they keep bidding the price of the stock market up, selling into it, making more money based on a fake market, based on private households, which are considered dumb money, the unsophisticated investors, coming in and buying all these stocks and following the market, following all the market hype, all this BS coming off the TV. None of those guys, they're news guys. They don't really know about the market. They act like they do. All they're doing is saying what they're told. And it's basically saying whatever Wall Street tells them so that they can prop the market up. The banks and the brokerage firms can sell all their stock at a super high price. And they've got it to a point where private households now own more than 60% of all the stock. That's only happened a couple of times in history. And that was like 1929 and the dot-com bubble that busted up to be the dot bombs. So when the inventory in the actual brokerage houses, when Wall Street says, hey, we don't want to own this stuff, it's way overvalued, it's exorbitantly overvalued, who would buy at these prices? But they talk you into buying them at those prices so they can sell them to you. And then they wait for the market to crash and buy low. I think the original goal was to try to wait till the election or try to push it off to the election. But the thing is the unemployment, all the economic underpinnings of true economy has reared its ugly head. And even the unsophisticated investor can know that if companies are laying off tens of thousands of people, if inflation really isn't in check, if it's getting harder and harder for them to even buy their own food and buy a new car and pay their rent that's increasing an exorbitant rate, or buy a new house, or do the things that it takes them to take care of their families, they're going, well, maybe this isn't really as good as it seems. I think the reality is finally seeping into the market, and the people that have been duped are saying, this isn't really as good as they say. Maybe we ought to take some profits. And then the unemployment goes down. The yield curve starts twisting back. They start talking about lowering interest rates. And by the way, I mentioned this before too. Every time the recession happens, it happens after the first rate cut, after a period like we're in right now, when they do some quantitative tightening or try to kind of manage inflation. They come in with a loosening of interest rates. In other words, a more dovish policy. It's hawkish right now, meaning, hey, we're not going to lower interest rates yet. No, the economy's still too good. Inflation's still kicking our butts. It's still high. We really have to wait for the data. And I think, unfortunately, Jerome Powell has the hardest job in the world because, he's got the White House not wanting him to do probably what's right. The Fed always comes in late. They always do because they're reactionary. They're not usually predictive of the future. But the thing is I think smart money has learned, and you look at history, is once there's a first rate cut, it usually is indicated that, we've waited long enough. The economy's in bad shape. We have to lower rates now. And all of a sudden, the economic fundamentals finally get to the market where there starts being sell-offs. And now there's still banks that want to sell, and they'll sell off and they'll prop the market up. They probably were the big portion of the people selling the last few days of a week and a half ago and then into the beginning of this week. But of course, there's always a balance. You get Kramer and those guys on TV that say stuff like, oh, buy the dip, buy the dip. Well, if it's a downtrend, it's not really a dip. We're due for a bear market. I want the market to reset to where stocks are at a reasonable, historical, reasonable value. I want to buy stocks when it's worth buying. I don't want to buy stocks when they're so overpriced that it doesn't make any sense. Just because the market's going up doesn't mean anything. Every crash has happened right after the market made new highs, and they're making this big deal like, the market's not in recession. Look at all these new highs we just recently made. Yeah, new highs that were so overvalued, it was just unreasonable. But it is what it is. They did make new highs. Yeah, okay. And so the next time there's a correction or even a crash, it's going to be not making new lows, but it's going to be taking some of those new highs away. There's always been new highs, and the all-time highs have always happened, before the next big correction or even the market crash. So I think we're just having what we've been due for. I know they keep saying, oh, this Fed is such a genius. They're manipulating us out of, or they're maneuvering us, through this economic weird stuff. And, we're not going to even have a landing, not even a soft landing. We're not even going to have a recession. I think just a few weeks ago, you were asking me that. And, other advisors that have radio shows, and I hear them too in this market, that say, oh, no, it's not going to happen. Just keep buying the market. It's all great. Well, most of us in this industry, I hate to say it, are puppets on the Wall Street string. Well, I was like that for 20 years or so because I just believed everything I heard. But then I realized they're manipulating me to be their freaking puppet. I'm not doing this anymore. I'm going to peel the layers of the onion back. I'm going to look behind the curtain and see what they're doing. And if they're doing some shenanigans and tricks that I don't want to play with, I don't have to play. I'd rather protect my assets and my clients' assets than, take a shot at, one more all-time high, because we've just seen over those last couple of weeks how fast the market can drop. I mean, it takes a week or two to go up 1 or 2%, but it can take a day to go down 3 or 4. Look at Japan. That had a sell-off of 12%, highest it's been since like 1989. Well, that was, over the weekend right before this last Monday, when our market goes like, oh boy, yeah, the world thinks we're going to melt down. Well, guess what? The world has smart money, and the rest of the world has economic data too. They see what's happening in the U.S. We're the leading economy in the world. Oh, by the way, manufacturing is down to less than 50% of capacity. Where's Bidenomics at work? Our manufacturing is going down in every sector in the U.S., for almost 2 years now on almost a monthly basis. There's been a couple of upticks in some of the sectors, but it's trending down in a big way. So, I mean, there's too many things that say we're going into recession. There's too much history that says we're going there. We are in a cycle that always repeats, and it's never different this time. That's what everybody wants you to say. They want you to buy the dip, and this is why. Because every time you buy a dip, the banks and the brokerage firms can sell more at a higher price. By the way, sometimes they're forced to buy the stocks out as they're sold, because they are the market. We had a lot of short sellers come in last Monday, actually the prior week and also Monday, a lot of short selling. And some of the companies, I heard Schwab by a big fund manager that I do some conference calls and have some internet contact with, said that there was no inventory. They couldn't actually short certain stocks because they didn't have any more to loan. There was so much shorting going on. Now, that's kind of a bet downward. And that's typically the shorting happens. People who short the market are typically more savvy. They're not just like gamblers. Gamblers always want to buy the ups and buy the dips. And, it's kind of bull market focused. Well, a lot of short sellers, these hedge fund managers, and they're shorting and then they're buying bonds. And so we're seeing some of the smart money telling us that this is where their head is at. But if they're getting too many shorts, pretty soon the people say, man, we made a lot of money. We've made 10 or 20% on our short positions. Let's take profits. As soon as they take profits, they have to buy those stocks back for the market maker. In other words, if Schwab ran out of, let's say, Intel stock because it was a heavy short last week, and it wasn't the stock, but let's just say they did. And then people say, oh man, it's down, it was $30 last week, it's $20 today, I'm going to sell it, or I have to buy it back. Well, they have to buy it. So now they have to come up with the inventory. They have to buy the stock. So they force the price back up. And we get these, sometimes we call them dead cat bounces in the midst of a falling market or a market correction or crash. We're at kind of correction territory because we're over 10% on all the indexes, by Monday of last week. We've kind of bounced around a little bit this week. I think the trend is still down. I don't think that just because the dudes on TV, the talking heads that don't even invest market and get it wrong more often than they get it right, are the ones that should tell us, oh, buy the dip, it's time to buy. Look at fundamentals. Are the companies actually growing earnings? Is the future outlook better or worse? Now, there are some companies that are growing earnings, but not very many. There's more companies that are surprising us to the downside, or aren't growing quite as well as they used to, even though it's better than they grew last year because, overall, the market was pretty flat as far as growth goes. But I mean, you can't have the market go up 40 or 50% and only have 7 or 8% growth in 2 or 3 years, total. That's just a disconnect in my head. The math doesn't work for me. And I don't think it works for the market when people finally stop, smell the roses, look around and see what's going on. And that's what happened. I think the market is finally getting smart, getting wise. The market is too strong to be manipulated forever. Pretty soon the market just says, I can't do it, and it just pukes, right? And I think people get a little wiser after a while. People get a little nervous. They know that this can't go on forever. And the more and more people that find out that this kind of a fantasy play here, believing that the market go to the moon when there's no fundamental supporting it other than, this fake money injection through the banks. And if banks are having defaults at their all-time highs, they're loaning less money than they've ever loaned, and all they have is the ability to buy and trade stock as their primary mechanism for making money or to growing their own wealth or making them look good because their stock's going up doesn't necessarily mean a bank is healthy. It just means that they've been buying more stock than selling stock. So there's just a lot of things I think that are finally coming to light. I think the people finally get the hint, like, wait a minute, unemployment's going up. This isn't really working. I thought unemployment was going down. Isn't that what Bidenomics said it was? They fixed unemployment. They fixed the border. They fixed the economy. They fixed the market. They fixed everything. No, they manipulated everything to make it look like it was going okay. And then they told us stories about it. But the reality is it's not. It's just been a big facade and it's been a big show. And when people start looking behind the curtain a little bit to see what's going on, they go like, oh, shoot, we better run for cover. Let's take our profits now while the going's good. And let's get out first before everybody else finds out that this is a scam and get out. Now, along the way, and this is an orderly correction, along the way, there should always be bounces. There's always going to be bounces. But what we'll find is the new highs are not going to be as high as the old highs. The all-time highs, I believe the all-time highs are in for a while. I just really have a hard time believing we're going to set a new all-time high before the election. It could happen, but if it does, that will be the last one. I think we're kind of done with all-time highs. We're getting really close to kind of running that gamut. That's just my opinion. I could be wrong. But I think we're kind of out of gas. And what we're going to see is these bounces are going to come up to kind of approach the all-time highs. They're going to hit resistance, and then there's going to be some more sell-offs. And pretty soon we're going to see this kind of like a sawtooth graph where, it kind of goes down and then it pops up about halfway and then goes down again. And, we keep trying to come back. And of course, the news is going to say, see, it's coming back. It's coming back. It always comes back. Well, it's not going to go back all the way to the prior high. We're going to get some lower highs and lower lows. And as that happens, it's going to finally come to grips with everybody that, this market is going to be in a downtrend. We're going to get back to reasonably, historically sane values again. And it may take a few months, maybe even into next year before it's finally said and done. But there'll be a time, I'm sure it's going to be after the election, that we say, okay, it looks like we kind of get a feel and a handle of what's going on in the market. It's time to buy again. And we'll be buying at much lower rates than we could buy today. That's my opinion. And that's what I think happened is we're kind of in that start of that correction phase that's going to end what started in 2022. And that is a market correction that should have got us back to normal values, but there was some intervention, some fake game playing behind the scenes that stopped it from happening. We got this fake bounce, AI hype, and that's going to run its course. And we're going to settle back into a normal market after this recession plays out, and we'll start a new uptrend. But that's the way the economy is. Every decade, there's going to be a really good crash. There's going to be recessions every so often. And let's just accept it. Let's just deal with it. And let's just not let it hurt us when it comes.
We're talking with Jeff Hogan of Premier Retirement Planning and Wealth Management here in Tucson. We've been talking about what has occurred this past week in the market and the economy, particularly on Monday when the Dow dropped 1,200 points. Later on in the program, we'll talk about the possibility of some rate cuts. But in the meantime, if you'd like to get in and sit down with Jeff, talk about your individual situation, how this market, this economy, where we're headed this fall into the next year applies to you and your journey towards a confident retirement, we're offering our Premier Retirement Roadmap. Very simple to get that. Call 520-780-9059. It's 520-780-9059. Make that call this weekend. Leave your name and telephone number. And Shelley will call you back during the week this coming week and set up that appointment for you. This is just a casual conversation. It is a no-tie zone. It's just an opportunity for you to sit down with Jeff on a one-to-one basis to talk particularly about your individual situation. And remember, no questions off limits. We'd love to have the chance to talk to you. 520-780-9059. Make that call this weekend. Remember, this one call could make all the difference. Jeff, time for a break. When we come back, we've got listener questions. And then later on in the show, we'll talk about the possibility of rate cuts when Premier Retirement continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shea.
Thanks so much for making us part of your weekend. You're listening to Premier Retirement with Jeff Hogan, founder and president of Premier Retirement Planning and Wealth Management in Tucson and Mesa. We've had a great show today, a great conversation. Jeff has had a lot to say about the market and the economy. If you have missed any part of our program today or you want to hear it all over again, remember we're also a podcast. Go to wherever you get your podcasts, search for Premier Retirement with Jeff Hogan. You'll find this show and all of our past shows so you can stay on top of your journey towards a confident retirement. You can also Google and ask it to find the radio program for you. I know that Google was just found to be a monopoly, but still, I Google things, and just Google Jeff Logan Premier Retirement. It'll point you right to the podcast. Okay, Jeff, we have listener questions this week. We'll start off with Scott listening to us in Rita Ranch. And Scott says, I'm almost 60. My wife is in her middle 50s. Our twins are almost 10. Because we had children later on in life, my wife hasn't worked in a decade. Our house is almost paid off. It's worth around $400,000. And I have $500,000 in my 401k and another $250,000 in various stocks and mutual funds. My wife does not have any retirement accounts. I plan to retire at 67. My concern is not only having to support my wife when I retire, but also our children who will be entering their junior year of high school. We do not have 529 plans for the twins. I have not seen any articles or advice columns for older parents like ourselves on what to do when you're at retirement age and you still have children at home. So the question is, I guess, what does he do?
Well, that's an interesting question. Now, there might be a few of those years you might be able to actually get a little extra Social Security for having dependent children at home. That might help a little bit with those bills, especially as they're dependents. But that's just going to be a few of those years based on your ages. Actually, your wife's young enough to where she may still be able to, I don't know, depending on how mid-50s she is. Anyway, there's some things you could do with Social Security that might help. But the main thing is I really wouldn't go rushing off to do a 529 plan. I'd really encourage your kids to be really good at sports or academics and get a scholarship. That would be a really good way to do it. I've got some clients that are fortunate enough to have that happen, and they've got some great education for their kids. But that doesn't happen to everybody. So just let's say they don't, and you need to worry about how to support them through this. Honestly, depending on where they go to school and how they go to school, consider trade schools if they don't really need a degree that includes math and sciences and biology, and overpay for what I consider the tuition at colleges now is ridiculous for what you get out of it, unless the job actually 100% requires it. Given the fact that you've got somewhat limited resources, I don't know what you're used to making right now. 500,000 plus 250. I'm guessing that by the time you're 67, you might be able to save maybe, and depending on how you invest, maybe grow your assets at least from a standpoint of income value at least to $1 million. That might supply about $40,000 or $50,000 in income through retirement plus Social Security. If you can live on 80 or 90,000, you're good. But if you have to use some of that $250,000 to put your kids through school, then you might be a little bit more pressed when it comes to how far that 401k money would go. You can always look at reverse mortgages and use the equity in your house sometime in the future if that becomes a necessity to increase your income, cash flow, or lifestyle needs. I'm not opposed to using the equity in your house. It is an asset. And if you want to live there and spend the rest of your days there, I don't think reverse mortgages are out of the question. Idea to at least keep in the back of your mind, especially if it is really worth setting our twins up and making sure that they get a good education so they get the best chance they can in life. Now, keep in mind, some people put their kids through school and then find out they move back in and can't find a job with a sociology degree or something that, they get. I'm just making a name up, but, there are certain degrees that don't have a large pool of employment opportunities that pay enough even to get out of, say, the debt that you might have incurred sending a kid to school. One of the things that I really like in lieu of a 529 plan, and that's something you might want to consider, and I don't know if you're making $200,000 a year now or $50,000 a year now, but if you're making, on the high end of that number and maybe living on half, and you could invest $50,000 or $60,000 in something different, I'd say consider, rather than putting away in a 529 plan, you might want to even consider a LIRP, life insurance retirement plan, which, if you get hit by a truck, they've got tax-free money to put them through college. But if you don't, you could actually keep the cash that you stuff into this LIRP, life insurance retirement plan. You can actually borrow against it, pay the tuition directly, pay bookstore tuition and some of those deductible costs for your kids to go to college, and actually borrow from your death benefit or borrow from your policy tax-free and still get a tax write-off against your future income. So that's a very tax-efficient way possibly to send your kids to school. Also, to make sure that if something happened to you and that earning power is gone, that they continue to be able to go. Your wife will have the extra income that she would need to continue to stay retired if you're not there to provide. Since she hasn't worked in a while, I don't know if she, has the capacity to go back and work at a high-paying job or any paying job based on the fact he's been out of the workplace and may not even have a job. So many jobs have become obsolete now with technology and stuff. It might be difficult for her to find a job like she had before. I don't know the whole situation, but those are all the things that I would consider in trying to develop a plan for you or develop kind of a good, hard look at, what your options are. But I don't like 529 plans. I think they're gimmicky. I just haven't seen one I like. I haven't seen one that actually works. I have seen more people end up giving them back away or taking them out or hand them to a different kid. I've had better luck with, tax efficient savings plans like LERPS, life insurance retirement plans, which you can use, cash in, use for yourself, use for your kids, use for anybody. You don't have to jump through hoops and play by weird rules in order to use the money in a different way if it turns out education isn't the way you end up spending it. 529s, you're restricted to, education, and there's too many rules, in my opinion, to make it worthwhile. Unless you just have one of everything else in the planet and you just want a 529 to round out your comprehensive portfolio of one of everything you can buy, then go for it. But it's really not a staple, in my opinion, of a retirement plan or even an income plan. I know there's people listening who are like, well, I have 529 plans. That doesn't mean you undo them. It just means if you don't have one, I wouldn't start one. I look at other options. And, the guy at your brokerage firm probably got a bonus for opening an extra account. Is probably why they're pushing it. I'm not trying to be cynical, but I think that's by and large why we have so many weird other things going on than just a managed brokerage account or mutual funds or ETFs or, just the typical portfolio management that we get out there. IRAs, 401ks, Roth IRAs, 529s, UGMA plans, uniform gift to minors. There's all kinds of weird things that can complicate your life that don't have to be complicated when you could use some of the mainstream ideas that other financially savvy people use without getting caught up in the mix of, bells and whistles or things that sound cool and look cool. 529s type your money so much. It's one of those things that the brokerage industry, if they sell enough of them, are going to have that automatic, going to always be paid fees for this thing as long as you live, because you can't really get them out and use them. So, unless you use them for exactly the thing that you planned for. Anyway, those are just some food for thought there. Don't know enough of your situation to give you a final answer, but those are some things you need to think about when you devise a plan for this.
Scott, thanks for listening to us in Rita Ranch, and good luck with the Twins. Once again, call Jeff at 520-780-9059. Sit down and ask him your particular question. We'll also be sending you out Jeff's book, Retirement: The Road Ahead. Next question, Jeff, is Nancy listening to us in Tucson, and she says, I love the advice and commentary you give on the radio. However, it seems that it is more for high net worth investors. How much money does one need to really get the potential benefit of using a financial advisor such as yourself?
Well, I don't know. I mean, I do talk about a lot of things. I talk about tax planning a lot, and typically you have to have, a reasonably good net worth in order to have a tax problem. I hope the advice that I give, I appreciate you liking the show and the advice that we talk about. I don't know what you mean by high net worth. I mean, some people, if you've got 10 cents in the bank, you think anybody with $100 is high net worth. If you got $5 million, you might not even think you're high net worth. You might think somebody over 10 might be. So I don't know what level you would consider high net worth individual. I think the mass affluent, which they call kind of the mass affluent person, is between $1 million and $5 million. That's probably the market that I work most often with as far as liquid net worth. But that doesn't mean that's the only thing that could help. I have a lot of people come with the $400,000 or $500,000 that want to make an extra $30,000 or $40,000 in retirement income, and they know that based on the 4% rule, it's only going to be 12 or 15 with their broker. And if we can upgrade it and use products like annuities and LERPs and other things to enhance income, we can make a simple tweak to your plan and give you a little lifetime pension that you can create yourself with a much lower net worth. We might not get into sophisticated tax planning or need a really good accountant to figure out all the ins and outs of maneuvering through your taxable situation, if we keep it simple. So I think when I talk about strategy, obviously if you're talking about a comprehensive plan, it usually means that there's enough assets to fill several different buckets or try several different things. But that doesn't mean that if you've got an average plan, that we can't make it an A plan, whether you've got a few $100,000 or a few $100 million. It just depends anywhere in between. It's just a matter of zeros. It's not a matter of strategy. It's also a matter of need. And if you don't have a tax problem and you just want income, we can take care of that without really even talking about the taxes or talking about portfolio management. If you want all liquidity because you've got a huge pension, but you want, all kinds of swing for the fences growth and try to hit some home runs, we could focus more on growth portfolios, long-term, things that aren't really necessary for income planning. But it just depends on where you're at. If you have a bigger net worth, obviously more of the things that I talk about would probably apply. And like I say, you can participate in more of the action if you have more net worth. And that's just the facts. It doesn't mean that if you have a problem that I'm not willing to hear your problem and try to fix it for you. So hopefully that's not been the case. And I'm glad you enjoy the show. And if you ever do feel like coming in and seeing what having a financial advisor would mean to you and see if the benefits feel like they would outweigh either the price you pay. And by the way, some of these things we can do on a one-off basis where we just fix you up an income plan. The companies often just pay me a one-time commission or they'll give me a residual fee, and it's basically not even managed. It's just autoplay. So you don't even have to pay a fee for some of the stuff we do. It could be more transactional. As a fiduciary, it doesn't mean you have to only charge a fee and only do portfolio management. Some of the people on TV do one thing and they act like that's the only way you can be a fiduciary. I think think a fiduciary is doing the right thing for you regardless. And it might be just parking your money in a series of, laddered annuities for the rest of your life. And there's really no follow-up except when to turn the next annuity on. So, and you could do that directly with the company. So there's things that you could do that you don't have to pay an ongoing fee to an advisor for. But if you want hands-on management, there might be a situation where you want to pay a fee because maybe our plan will save you more in taxes than you'll ever pay in fees. If I can save somebody, if they've got a portfolio and we can show them how if they pay an extra $5,000 or $10,000 in taxes for the next 5 years, they can save $5,000 or $10,000 in taxes for the next 30. They're going to save more in tax savings probably than they'll ever pay me in fees. And I think that's a pretty good trade. So again, it just depends what you're getting. I think whether you have a high net worth or a low net worth or somewhere in between or no net worth, I mean, if you pay a fee, I hope you're getting something for it. And it doesn't necessarily mean that you're making more money than you would have if you did it on your own. The thing is you probably won't do the same things on your own. Some people say, yeah, you could have just invested in an index fund and saved a lot of money. Well, your advisor probably didn't just do that. If all he did was park it in a mutual fund, then I think, yeah, it's kind of ridiculous charging a fee for that unless you get annual reviews, you're getting your trust looked at, you're getting your taxes done, you're getting your income planning looked at, you're having some consultation that justifies paying a fee because, at every office, including mine, we have a light bill, we have overhead, and we have some things that need to be paid. You can't work necessarily for free, but you also don't need to rip off the client and give them no service and get a fee. So I think it has to be a win-win. You need to look at that, maybe kick the tires at a few different firms and see if you're getting the value you want, or see if you even have enough net worth. Some of these companies won't even take you because they want to make a certain amount of fees on you. So, we're not like that. It's just if we can make your situation better, we'll show you how we can do it. And if it can be done in a visit or two, great. If it is an ongoing relationship that you need, then we'll suggest doing that as well.
Nancy, thanks for listening to us. We'd love to talk to you. So give us a call, 520-780-9059. Make the call this weekend, and Shelley will find a place for you, 520-780-9059. And, of course, Nancy, you'll get the book, Retirement: The Road Ahead. Next question, Randy's listening to us in the Catalina Foothills, and Randy says, I'm 53 years old. I plan to retire at 60. I feel I'm on track financially. I currently have about $700,000 in taxable accounts, about $1.2 million in traditional IRA or 401 accounts, and about $300,000 in a Roth IRA. I've always contributed to a traditional 401k at work. I try to max it out, but usually get a refund after our compliance testing. We now have an option for a Roth 401k, and I'm wondering if it makes sense to switch to a Roth 401k for the next 7 years to possibly avoid RMDs in the future.
Well, I would say based on your level at 53 years old, you're making in excess of $200,000 a year, probably $200,000 to $250,000, and you probably want to live on at least half that in retirement. The fact is that you're paying a lot of taxes, you're paying for some benefits, and you're also maxing out your 401k means you're probably in the 22 bracket now, 25 or higher. And after the Trump tax cuts go away, if they do, if he doesn't get reelected, I hope he does, and extends those tax breaks some more. But you're going to be in the 22 to 25% tax bracket most likely. What I'm not sure about is when you're 60, you might want to wait and not do the Roth IRA, since every dollar you put into the Roth, now you're going to pay probably 24 or 25% taxes on, or maybe even a little bit more depending on your income or your household income. I don't know what your wife does if you're married or if you're single. But you didn't mention a wife, so let's just say you're single. You're going to be actually in a higher tax bracket than I just said, 250. That's going to put you in the 31 right now, and probably the 30 plus bracket if you're single. While you're working, I would not do a Roth and pay tax at that bracket when at age 60 you could probably roll $100,000 or $150,000 out of your IRAs and 401ks and change those to a Roth or do a LIRP, which I think is even better, and use the taxable or the non-qualified accounts to live on, because those are not taxable. You've already paid taxes on them. To live on those during your 60 to say 70 years, for 10 years, you could divest of everything and still never have to take RMDs, and never get yourself into a 30% tax bracket ever again. Keep yourself in a 20-ish tax bracket, 20 to 22, or even the 15 bracket if you do it right. So I would definitely, if you're single, making more than about 100 and Actually, if you're single, making more than 100 taxable. If you're married, making more than 250 taxable. I would say don't do the Roth conversion now. Pay taxes later, because you're going to have a nice window of tax planning, in my opinion, between age 60 and 73 or 75. After you're 53 now, shoot, you can wait till 75 to take the required minimum distributions. You have all kinds of time to make those Roth conversions later at a much lower tax bracket. I would continue to defer. I would continue to grow those accounts to the maximum. Take your maximum match, definitely. But I would consider one thing in lieu of a Roth. With those things, you've already amassed $700,000 in taxable accounts, which means you live on less than you make. You've been able to save. I would take that money and even start moving that money and the excess earnings. Let's say you're living on 120 but making 250, maybe taking home 180. Let's say you put that extra $60,000 or $70,000 instead of sticking it in mutual funds and ETFs and different things that may or may not cause you a tax problem every time they make money, but put them in a LIRP, life insurance retirement plan, stuff that thing full, and then you get tax-free income, which you can start taking as soon as you retire at age 60 and actually supplement your lifestyle with those dollars. You could even move that $700,000 over the next 7 years between now and 60 into a LIRP. I'll just give you some examples, and then take $60,000 or $70,000 a year tax-free to live on, plus maybe a little bit out of your IRA to live on, and still convert another $100,000 a year for the next 10 years and be pretty darn close to tax-free when it comes RMD time. And guess what happens then? If that's the case, you might actually get to a place where your Social Security may not even be taxable. You might be able to live on $100,000 or maybe even $150,000 a year and pay zero in taxes if you do it right. So again, look at the whole picture. I'm just looking at these numbers. You're at a great place at 53 to already have that big of a head start over most of your peers. Most people don't even start saving until they're 53, and you're already down that road. So good for you for being ahead of the game. Good for you for spending less than you make. It's obvious. And good for you for asking smart questions. But I would not pay taxes at a higher bracket. I would pay taxes at a lower bracket. Even though it's on more money, you would pay it over a period of time, but you would be saving more taxes when you look at the tax savings of the compound interest on those tax savings at your current bracket rate.
Randy, thanks for listening to us in Catalina Foothills. And of course, we'll send you out Jeff's book, Retirement: The Road Ahead. And if you'd like to talk to us, 520-780-9059 is the number to call to get your premier retirement roadmap. And for the rest of our listeners, of course, every week we do offer this opportunity for this retirement roadmap. No cost, no obligation. To get it, call 520-780-9059. Do it this weekend. An opportunity for you to sit down and have a confidential conversation with Jeff about your personal situation and your journey towards a confident retirement. Again, it is just a casual conversation. No hard sell here whatsoever. Take advantage of this opportunity this weekend by calling 520-780-9059. Leave your name and telephone number, and Shelley will call you back during the week to set up an appointment for you. And you can also find out more about us online at premret.com. It's premret.com. Jeff, I saw a conversation this past week with Jeremy Siegel, who's a professor of economics at Wharton College. He was calling for a 75-point basis cut here in September and another one later on in the year. Now, that's not going to happen. What do you think a likely rate cut would be towards the end of this year? And do you think that we're going to have an emergency rate cut? And if we do, what's going to happen to the stock market? Will it stay the same or will it rip?
Well, they got this plunger team, they call it, that, keeps the stock market from plunging. I guess that's probably why they named it that. But Wall Street continues to kind of manipulate the market. If it looks like it's having a sell-off, what they'll do is they'll buy futures and kind of give stimulus to the unsophisticated investors to want to come in and buy because they think it's time to bounce, or they think it's buying the dip and they think it's time to buy. And we're going to get some bounces in the market. Now, I don't know that we'll have an emergency rate cut unless we continue to have 1,200-point drop days. One is not going to cut it if we have a few bad days. But, if the market goes down 1,200 or even 1,000, bounces back the next day 500 or 600, like on a Tuesday right after the Monday, it's still not going back up. We didn't get it all back, but sometimes that kind of pacifies the market. Say, at least we're not in free fall anymore. And, maybe the Fed will kind of hold it off till the September meeting. It's not that far off to wait till the September meeting. I think when they do an emergency rate cut, that almost is admitting that the economy's in a tailspin, and that sometimes will freak the market out and make people want to be more excited about selling or getting crazy about it. So, whether we have an emergency rate cut or not, and it could happen anytime, I don't know that there's a reason to expect an emergency rate cut. I don't know that there's even a reason to lower interest rates based on the inflation data. We don't. The only reason we would lower interest rates is to somehow stimulate the economy, actually to stimulate the market, to make the election look less problematic for the people in power. But all a rate decrease does is increase inflation. It increases money supply, essentially. It gives people, hope that the market's going to do better, but it's also a signal that, hey, the economy's in bad shape. Maybe we have to rethink where the market is and, let the market reflect the economy rather than have the market, somehow indicate that the economy's better off than it is. Well, it hasn't been. The market's been great. The economy hasn't for a long time. We've had economic indicators, the economic indicator index. The leading LEI, the leading economic indicator index, is down like 14 out of the last 16 months. Anytime it's dropped more than 12, we've had a recession. Manufacturing is down. Anytime it's gone down more than 12 months, in the prior year or two, like it has, we have a recession. Every time the yield curve inverts, we have a recession. When it uninverts, and by the way, when it uninverts, meaning when we have a rate decrease, when they start lowering rates, that uninverts the yield curve. As soon as that yield curve begins to uninvert is when the recessions historically have started. So we're still within that 2-year window of time when that yield curve inversion can still play out and be within the norms of history. Or we can maybe stretch it out a month or two, maybe even a quarter, and stretch out the window that it happens. But I don't think we're going to escape it. I just have not seen a scenario, as much as I want to see a scenario where it doesn't happen. And by the way, we've still got something I didn't mention earlier, but you've got Janet Yellen playing the Treasury bill game, stimulating the economy by basically she's printing money backdoor, the Department of Treasury, and creating money there where they're really not doing anything to stop inflation. You know what's stopping inflation is people can't afford to buy more stuff. That's what's stopping inflation. It's just the fact that people are out of gas. They've tapped them for everything they have. The middle class can't buy stuff. The rich people can. And the rich people are enough to keep inflation growing at 2 or 3, 2.5%, 3% or so. Businesses continue to have to pay more and more for their products, services, and their goods to produce their goods. So I don't think that there's any reason to lower interest rates other than the fact that the economy is going to slide into some sort of a recession where people are going to just need to be able to borrow money to get out of their problems. Problem is people are already so leveraged and have borrowed so much money, and so many can't pay it back. Banks are seeing their highest default rates ever. There's like $1 trillion of outstanding credit card debt and things that just have never happened before. And this is just for people trying to make ends meet. Pretty soon those credit lines are going to dry up. The banks aren't going to get their money. The Fed's going to have to bail them out. And guess what a Fed bailout is? Every time the Fed bailout's just like printing money. But do you and I get any of that money? No, the banks do. The big businesses do. They get propped up. The market looks like it's doing great. And everybody wonders why living, the lifestyle is getting tougher and tougher to make ends meet. And living gets harder and harder. So I hope we can flip this around. I think Trump, a businessman who, whether you like him or not, understands economic principles a lot better than the powers that are in there now that just want to tax the crap out of us and pass it out and pass it around to their friends. And they don't realize that that's kind of like the Roman Empire. They had no middle class paying taxes. They kept taking everything and kept living the life of luxury and life of decadence and amorality. And that's the way, just look at it. They're flaunting it in front of our faces. It's like there's no rules, there's no morals, there's no ethics. There's an agenda that is basically to tear down and make everything that used to be good bad and everything that used to be bad good. And I don't understand what the agenda is supposed to accomplish other than I think it's evil at its best and the dark world emerging as normal. And I hate to say it, but it is. We've got to hopefully get through this next election and try to fix the things that are wrong. And I got a little off track there because it's not just about the market and it's not just about the economy. It's about America. It's about our life. It's about our values. It's about so many more things. And I guess in order to live our life and to enjoy the freedoms that we have enjoyed for so long, we need money to do it. And my job is to help people not lose it and do the best they can given what we've got to work with. I don't have a crystal ball, but I do know the market's at unprecedented highs. And it's at kind of an anomaly where it is as far as pricing. I know that we've still got a lot more downside in store. I know that the government is always reacting too late, like they're probably going to do now. So when it comes to an emergency rate cut or any rate cuts, I'm sure they're coming soon. And I'm sure it's just going to basically put the nail in the coffin as far as, the economy, it's finally going to be an admission that the economy's not as good as they've said it was. Bidenomics really didn't work. And, we've got to go through kind of a reset period, which is root word of recession, reset, right? We got to reset. And there might be a few hard days before we get back to the good ones. But the good ones will come again. It's America. We seem to always go in cycles. Things always get better. The pendulum swings. And, it might not be in a comfortable spot right now, but it'll get better. And we just have to weather the storms ahead.
Jeff, once again, I hate to cut you off, but we're out of time for this week. Once again, if our listeners want to have a chance to sit down and talk to you, 520-780-9059 is our telephone number. No cost, no obligation, no judgment. 520-780-9059 or online at primrat.com. Jeff, it's been a pleasure to talk to you. I want to thank you for your time. Most importantly, I'd like to thank our listeners for joining us here in Tucson and Mesa. For Jeff Hogan, I'm Jeff Shade. Have a great weekend. We'll talk to you again next week with another edition of Premier Retirement right here on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage, Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.